You're a renter. Get over it. But it's not because you're doing something wrong. It's because the game is changing. Like it or not, we're drifting towards becoming a renter nation. And the crazy part about this entire thing, it's not just about you or your situation. It's about the entire American dream being rewritten in real time. Let's rewind to post-World War II era. A time when the American dream was reshaped, veterans returned, jobs were booming, and the government stepped in to ensure that homeownership wasn't just a privilege for the wealthy, it was a goal within reach for everyday Americans. Back then, the GI Bill, FHA loans, and VA mortgages made it possible for the working class families to own a piece of land, plant some roots, and build wealth over time. The 30-year fixed mortgage was introduced to provide stability and predictability. The suburbs exploded with development, fueled by affordable land, low interest rates, and a booming post-war economy. Owning a home meant you were moving up. It wasn't just about shelter, it was about security, it was about freedom, it was about American pride. Owning a home was a rite of passage. Your first mortgage was a badge of adulthood. Fast forward to today, and that same dream is becoming unrecognizable. The tools that made it work, they're not broken, but they're out of reach. You can't build equity if you can't afford to get in the game. And that's the kicker. We're not dealing with a one-time hiccup in the market. We're witnessing a deep, systemic transformation that's affecting everything from intergenerational wealth to local economies. In the 1950s, 60s, and even the 80s, owning a home wasn't just about having a roof over your head. It was about planting roots, accumulating wealth, and establishing financial security for you and your family. It was the single biggest wealth building tool for the American middle class. Now, that door is closing, and it's closing fast. Let's talk about what's changed. Home prices in the U.S. have risen over 118% since 2000. That's nearly double the growth of wages during the same period. For young professionals entering the workforce today, home prices look like a joke, a punchline to a cruel reality. The average home in 2000 cost about $125,000. Today, $428,000. That's not luxury, it's just what a median single-family home now costs. And depending upon where you live, that number can skyrocket. In places like San Francisco, Seattle, or New York, good luck finding anything under $700,000. In the suburbs of Atlanta, Dallas, or Denver, median prices now hover around $450,000 to $550,000 for a modest family home. And at the same time, the average American wage hasn't kept up. Wages have increased, sure, but not anywhere near the level needed to match the pace of housing inflation. You just can't budget your way into a $100,000 down payment. Now, toss in mortgage rates. In 2020, a buyer could lock in a 30-year fixed interest rate below 3%. We've talked about that ad nauseum. That number changed the game. It brought buyers off the sidelines. It supercharged competition. By 2023, that rate hit 7% in some markets, actually 8% in a lot of markets. So let's break that down. A $350,000 home at 3% meant a monthly payment of around $1,400. Affordable, manageable, even for a single income household. At 7%, the same loan is over $2,300. That's a difference of nearly $11,000 a year. And that's before we talk about property taxes, which have increased in many fast-growing counties, or homeowners insurance, which is spiking due to climate change, risk zones, catastrophic events, you name it. This isn't just a red line on a chart. It's real monthly reality that decides whether families can buy or rent. And right now, more and more families are sitting on the sidelines. Let's say you could swing that monthly payment. Let's talk about the upfront cost. The traditional 20% down, of course, you can put, there's zero down payment, there's 1%, 3%, 5% options, but a 20% traditional down payment on a $428,000 home, that's $85,600. Even at 10% down, it's over $42,000. Throw in closing costs, inspections, and you're up around $50,000 out of pocket. For the majority of Americans, especially the younger ones, those numbers are deal breakers, especially when inflation continues to eat into disposable income and savings accounts being drained just to keep up with the rising rent, food, and fuel costs. According to Bankrate, only 32% of all millennials say they have enough savings for a down payment, and Gen Z, even less. High rent costs, student loans, inflation, and just the general cost of living are eating up anybody's ability to save. We're seeing buyers with good credit and solid jobs who still can't qualify because they don't have the liquidity. The cash simply isn't there. It's not a laziness problem. It's a systemic issue. It's the result of years of financial stress and zero access to the equity ladder. And when the down payment remains out of reach, ownership isn't delayed, it's denied. But the story doesn't end there with personal finances. There's a major structural force at play here: investors. And they're reshaping the housing market at scale. Institutional investors, Wall Street firms, hedge funds, and massive real estate conglomerates are buying up single-family homes in record numbers, albeit a lot less than what they were. But in cities like Atlanta, Charlotte, Phoenix, and Tampa, over 1 in 4 homes are being snapped up by investors. They're not buying 1 or 2 properties to flip. They're buying thousands, entire neighborhoods, entire subdivisions. They're coming in and they're paying cash. They're outbidding families. They're not constrained by mortgage approvals, inspections, or timelines, and they're turning these homes into long-term rentals. Build to rent is no longer a niche. It's a growth industry. Developers are constructing entire communities with zero intention of ever selling to individuals. These homes are designed for permanent rental. That creates a feedback loop. More homes off the market, more competition for buyers, higher prices, more permanent renters, and these aren't low-end homes. They're the exact homes that first-time buyers used to compete for. Now, good luck even getting a tour. There's also a major cultural shift playing out across generations. Millennials and Gen Zs aren't just battling affordability, they're rethinking the entire premise of homeownership. For many, homeownership no longer symbolizes freedom. It represents debts, restriction, and risk. They watched their parents lose homes in the Great Recession. They grew up on headlines about foreclosure, underwater mortgages, and bailouts. To them, ownership isn't a dream, it's a cautionary tale. Add in a culture that prioritizes mobility, minimalism, and experiences over assets, and it's no wonder more are opting to rent longer. But that doesn't mean they don't want to own. The vast majority still aspire to buy someday. They just don't see a realistic path forward. That kind of deferred hope builds frustration and even apathy. And the longer you wait, the more it feels impossible. That's not a mindset problem. That's a market problem with psychological consequences. Geography plays a huge role in this shift too. Where you live massively impacts whether you can afford to buy. In cities like San Francisco or Manhattan, renting isn't just normal, it's necessary. It's a way of life. Even high-earning professionals can't crack the ownership code in those markets. But the squeeze is spreading to smaller metros. Places like Nashville, Boise, Austin, they all used to be affordable. Now, the median home prices have doubled or tripled in under a decade. The irony, the places where jobs are booming are the same places where homes are out of reach. And the places where homes still are affordable, they often lack economic opportunity. So people face an impossible choice. Live where you can grow your career, but rent forever. Or buy where the jobs are and stability isn't. That's not real freedom. It's a geographic inequality at scale. So what now? Do we just accept this? Is homeownership reserved only for the wealthy, the connected, or the lucky? No. We fight back with smart, layered solutions. Expand down payment assistance, not token grants, a couple $1,000 here, a couple $1,000 there. Real capital, $25,000 to $50,000 targeted to middle income buyers, especially in high cost markets. Reform mortgage underwriting. Consider rent payment history a bigger priority. Rethink student loan metrics. We have to update how we assess creditworthiness. First look programs for residents. Before investors bid, give primary residents a 30-day exclusive window to buy in their neighborhoods. Look, it's not a fix-all solution, but it can help. Zoning and development reform, legalize multifamily units and single-family zones, streamline permitting, incentivize infill development near transit, shared equity models. Let cities or nonprofit coexist with buyers. Split the appreciation. Build equity without demanding full ownership up front. Financial literacy and buyer coaching. Got to start early. High schools, college, community workshops. Make it accessible and personalized. Employer housing incentives. More companies should help with down payments or relocation grants as recruitment tools. This would be a great option for keeping somebody on staff for a longer period of time. Public-private partnerships. Combine local government land with private builders to create affordable homes at scales. Look, again, it's not a fix-all solution, but they are options, and they aren't pipe dreams. They're already being tested in pilot programs across the country. We just need to go a little bit bigger. We need to scale these options so more and more people can take advantage of them. We are absolutely at the risk of becoming a renter nation, meaning more people are renting than buying. But we don't have to stay that way. Homeownership still matters, not just financially, but socially. It builds roots, it builds resilience, it builds equity. And equity builds freedom. So yeah, if you're renting, don't feel ashamed. Feel informed, feel determined, because the system isn't set up to help you. I am, and that's guaranteed.